about recording accounting transactions that involve stock. Now, as you can see on my screen, well, your screen, it says that there is no account for stock, but there are 4 different accounts that regulate stock. So there are 4 different accounts that regulate stock. So whatever the transaction is saying about stock, right, that transaction will affect one of these accounts here. It's either going to be sales, purchases, sales returns, aka return inwards, or purchases return, aka return outwards. So there's no stock account. So I shall never ever see something like this being done with a stock at the top of it. That is a definite no-no for double entry recording of accounting transactions. There is no account for a stock. We just have these 4 different accounts that regulate stock. So if we sell stock, we draw up a sales account. So whether we sell stock for cash or on credit, we will draw up a sales account for that. A purchases account is for when we buy stock for cash or on credit. Sales return is for when people to whom we've sold goods on credit return some of the stock we sold them on credit, right? So this is credit sales return of stock, right? And purchases return is when the business returns goods that it bought originally on credit from other people. So this is credit purchases return, a return of credit purchases. Alright, so these are the 4 different accounts that regulate stock. Sales, when you sell stock. Purchases, when you buy it. Sales return, when customers return stock to us. And purchases return, when we return goods to our creditors that we took goods from on credit. And these are the 4 different accounts that regulate stock. But let us just look on how these accounts affect stock so we can know. Now sales, when we sell stock, we decrease stock. So sales will decrease inventory. When we buy stock, we actually increase the amount of stock we have. So purchases will increase inventory. Think about it and agree, or you can ask me the questions in the lecture. When we have sales return, which is people actually returning their sales that we made to them, this will also increase inventory. And when we return inventory that we bought from people, purchases return, that will decrease our inventory. Remember, inventory is an asset, so the double entry rule for stock, aka inventory, applies to, as in the double entry rule for assets applies to stock. And it says to increase an asset, debit, and to decrease asset, we credit. And we're talking about the asset of stock. So these accounts that are increasing and decreasing it, right, will determine whether we're going to debit that account or credit that account. So let's look, for example, on sales. Sales decreases inventory, right? Inventory is an asset. To decrease, we credit. So the sales account is always credited because it decreases inventory. And there's another reason why we credit the sales account too, because it's a revenue, and to increase revenue, you credit. And for purchases increases inventory, so it is debited most of the times. Sales return increase inventory, it is always debited, it's never credited. And purchases return, it decreases inventory, so it's always credited because inventory is an asset and the double entry rule always applies. So if you don't know your double entry rules by now, you need to go back, learn them before you try to ever do any double entry. Know them better than how you know your middle name. Thank you. Toodles.